Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings so you don't have to. Today we're diving into Agree Realty Corporation's latest proxy statement, a document at first meet. There's some juicy information hidden in here, including a proposal to ask shareholders for basically double the company's available money to use. We'll find out more why. We're talking about Agree Realty Corporation, a real estate investment trust or REIT that mostly owns and manages retail properties leased to big name stores. They like to focus on tenants who are financially stable, so you'll often find them working with companies like Walmart or Dollar General. Let's look at some business highlights. In 2024, they invested over $950 million in new properties, showing they're actively growing their portfolio. Core funds from operations, or core FFO, a key measure of REIT profitability, increased almost 4% to $4.08 per share, and they boosted their dividend by almost 3%. They also completed a bond offering, raising 4.5 rating, increased almost 4% to $4.08 per share, and they boosted their dividend by almost 3%. They also completed a bond offering, raising 4 share, and they boosted their dividend by almost 3%. They also completed a bond offering, raising 4 share, and they boosted their dividend by almost 3%. They also completed a bond offering, raising 4.5 tafta. Iedereen at alsoos 4% to $4.08 per share, and they boosted their dividend by almost 3%. They also completed a bond offering, raising $450 million bond offering, raising $450 million, and expanded their credit facility. Here's something important. Agree Realty boasts it has delivered top-tier total shareholder returns. When stacked against similar companies, they are doing quite well. The company makes sure their executives are paid well and aligned with performance. They link pay to goals, have clawback policies if things go wrong, and ask executives to keep a healthy amount of company stock to align with shareholders. Now, let's talk about governance. 9 out of 10 of their directors are independent. They also have a lead independent director to provide balance and hold meetings without management present. The company emphasizes environmental, social, and governance matters also, making sure they do ESG training with team members and that their new tenants do ESG as well. Now let's get into the proposals that shareholders will be voting on. They need to elect 3 directors, ratify their accounting firm, vote on executive pay, and approve an amendment to their corporate charter. This last one is interesting. They want to double the number of authorized shares of their common stock from 180 million to 360 million shares. Who are the big stockholders in the company? Well, Vanguard Group owns 13.2% of the company, BlackRock owns almost 12%, and Cohen & Steers owns about 9%. So these 3 combined have a lot of voting power. The company does not allow its executives or board members to engage in hedging or pledging of company stock. Hedging is when someone takes action to protect the value of a stock from declining, and pledging means using the stock as collateral for a loan. How are the directors compensated? Each non-management director gets an annual fee of $185,000. They can choose to take some of it in stock. The lead independent director gets an extra $30,000, and the chairs of certain committees get additional payments as well. Richard Agree, as executive chairman, received time-based restricted shares valued at over $500,000, which vest over 3 years. Let's check the executive officers. We have Joel Agree as President and CEO, Peter Coffenor as CFO, Nicole Witteveen as Chief Operating Officer, Craig Ehrlich as Chief Growth Officer, and Danielle Spehar as General Counsel. These are the people steering the ship, so let's see how they get paid. Here we get to the good part. Let's briefly cover the summary compensation table. Joel Agree, the CEO, had total compensation of about $8.35 million in 2024. This included a salary of $900,000, stock awards of $4.8 million, and incentive plan compensation of over $2.5 the CFO got about $2.5 million. Peter Coffenor, the CFO, got about $2.5 million. Peter Coffenor, the CFO, got about $2.8 million. Peter Coffenor, the CFO, got about $2.8 million and incentive plan compensation of over $2.8. Looking at outstanding equity awards, we see Joel has unvested stock awards worth over $3 million. These vest over time. Peter Coffenor has them worth over $500,000, also vesting over time, and so on. What happens if things go south? Let's peek at potential payouts upon termination or a change in control. If there's a change in control and Joel Agree is terminated, he could get a package worth around $14.7 million, including $7 in millers, including accelerated vesting of his stock awards. For Peter Coffenor, it's about $1.6 million. Now, how does this pay stack up against performance? The table says the CEO's pay has gone up and down a bit over the last few years, roughly trending with the company's value as well as its peers. The auditor gets paid handsomely, but it seems mostly focused around actually doing the audit. In 2024, Grant Thornton received around $950,000. Finally, the board urges you to vote for the director nominees, for ratifying the accounting firm, for executive compensation, and for that amendment to the charter to increase the number of authorized shares. Here's the deal. The proposal in increasing the amount of common stock is about them wanting to flexibility in growing the company for years to come. More specifically, they might want to use it for more transactions to raise capital or acquiring other properties. To offer dividends in stock form or strategic reasons, a company buys another. If they can't issue new shares, their growth and capital raising options might be limited. Now, of course, it's always good to consider the flip side. Additional shares may dilute the red flags there. A well-managed real estate that continues to deliver value to their shareholders. A well-managed real estate that continues to deliver value to their shareholders. That's the rundown. Make sure to check out the actual filing of my take. Agree Realty seems like a solid player in the REIT world. The risk that I see is that interest rates keep rising and they have a hard time growing their profit from each new property. If I were a shareholder, I'd vote for it on these new proposals and have faith in the management for a company this size. And there you have it, another corporate filing decoded. Thanks for watching. If you enjoyed, please subscribe, like, and comment.